Most investors believe that they're diversified, but when the market drops, they discover they've been taking the same risk in 10 different places. Today, we're exposing the illusion of diversification, and we're going to show you what the smart money does differently. What you learn could completely change the way you look at your investments. Hey everyone, Mark Miller here. Are you truly diversified? Well, let's find out. I want to introduce you to Stephanie Riccio, one of our top wealth planners at Hilton Tax and Wealth Advisors, and we're going to explore that exact question today. So welcome, Stephanie.
Great to be here, Mark. I'm going to dive right in. When investors tell us that they're diversified, what do they usually mean?
What they usually mean is maybe they've had a retail advisor with, one of the brokerage firms or something, and they have a lot of different accounts, and they have a lot of different positions. They're chasing returns, trying to get the best returns, all of that, and they might have a ton of different positions in different accounts. So their advisor has made it feel like they're diversified, but often when we take a look at it, we find they're not diversified at all.
Yeah, I see that. So what's the difference between owning many investments and true diversification?
So owning many investments, and actually I'll let you attest to this, when clients first come to us, what do you see a lot when they bring you all their brokerage statements and everything?
Yeah, so, commonly all the retail portfolios we see, they hold multiple positions in them. So 70, 80, 90, even more within one account. Reason being, all of these retail advisors, they generate fees and commissions for each trade that they make. So more positions leads to more transactions, which leads to more revenue back to that retail advisor.
That's right. And we do see that all the time. And that's been a thing for years.
Yeah.
And by the way, just prepping everybody, both Stephanie and I have been on the retail side. So you'll hear the word retail a lot. We know kind of what the game is. And that's kind of the reference that we have when we talk about these things.
Yeah.
So I see they'll have a lot of different positions. And again, I go back to it's really about chasing returns and that broker trying to get the best returns they can. And sometimes they can, but like that one account will sit there and they'll say, this is the one that's going to give us really return. And by the way, we're going to manage that. And we're going to move the positions around. We're going to buy and sell stocks, or generally it's a stock portfolio. But then there's like $3,000 or $4,000 or $6,000 a year that's generated in commissions from doing all of that. And overall, it's not giving them any better returns.
Yeah, so can two portfolios look different on paper, but essentially be carrying the same risk?
Absolutely. Okay. It's because there's overlap. So, or like even if you talk about two positions or two like accounts or something like that, there's often so much overlap because, for instance, like NVIDIA is the number one bought stock right now. It's a hot stock, right? But if you have, let's say, 10 mutual funds, you may have a growth mutual fund, an income mutual fund, even an international mutual fund or whatever, and it's got NVIDIA in there 10 times. And you don't even see it, and you don't know how much exposure you have to actually a high-risk investment.
Okay. So if the number of investments isn't telling us about the diversification, what should clients be looking for?
So what they need to look for, let me talk about diversification, because that's mainly what we're talking about today. Diversification is having a lot of different types of investments in different asset classes. Okay. So for instance, we were working with a client today, right? That had 100% of their money just in managed money. And I'll talk about how we design our portfolios in a few minutes. But they were all exposed really to managed money, which again, with 70 or 80% of their assets just having stock exposure, complete risk exposure. Okay, so there is so diversification is those different types of asset classes, different investments. Then allocation is what percentages do you have in those to have a balanced portfolio. And that can't be figured out by just a simple, hey, we're going after the best investments.
Yeah.
It has to be a structured, and the smart money always has a structured process to be able to do that and design that diversification and allocation perfectly.
Okay. So how can a client own different mutual funds, retirement accounts, investments, but still have this portfolio overlap?
So it just happens all the time. It's because, again, they're not looking, they're not diving deep enough. They're not deploying the right strategies to truly make sure that synergistic balance is there.
Would you say that using different financial institutions can solve this problem?
No, because I think that's a big thing that people say, well, I've got money at 3 different brokerage, like I have something at Edward Jones, I have something over here at Fidelity and Vanguard, or Schwab or whatever it is. And they think, okay, well, if I have it at different institutions, that can give me some diversification. And I do have people, it sounds like common sense that, that would give you diversification.
Yeah.
But some people actually come to us that have a lot of money and will believe that. Well, I've got money over here with this one advisor and that with another advisor and this with another advisor. So they're doing different things. So that gives me diversification, and it does not at all.
So someone could essentially have 3 different financial institutions, but the exact same portfolio?
Yes. And it happens all the time.
Wow.
We've seen that, right?
Yeah.
So many times. And again, it really boils down to one of the things that we do when clients come to us to begin with, and I know you're in charge of a lot of this, is to do a risk and wealth assessment.
Of course.
So what are we trying to find out with that risk and wealth assessment?
We're trying to look for any inefficiencies, any overlapping or duplicate positions that are within multiple accounts that they have.
Right. And internally, we have a lot of algorithms, all this stuff. We've done this with hundreds of clients.
Yeah.
And we know how to do this like the smart money does it.
Yes.
As opposed to how the retail side does it with kind of simple pie charts and things like that. Oh, you look good because you got 40% over here in bonds and stocks. You're well balanced, right? You're totally well balanced.
Yeah.
And we often just know that's not the case, especially when we see the results of the risk and wealth assessment.
Yeah. So, from my experience on the retail side, and for decades, you've always heard that if you have a good mix of stocks and bonds, that will solve your diversification problem. Do you find that could happen?
No, this is the age-old 60-40 model.
Oh, yeah.
And most of you out there have probably heard about this. By the way, if you follow us, you've already heard me kind of pound away at this. The 60-40 model doesn't work anymore. Basically, the concept is let's put 60% at market risk or in stocks and 40% in like fixed income or bonds. And then we've got a well-balanced portfolio, and that should protect us, right?
Yeah.
You know what? That model has been dead since the 90s, especially what really made it dead was the dot-com bubble.
Okay.
When both stocks and bonds went down at the same time. So the whole premise of that was if they were uncorrelated assets. And that made sense for a while.
Yeah.
Okay? But that's just not the case anymore. We've had 3 or 4 years where stocks and bonds have gone down together.
Yeah. Yes, I saw that. So, if this is outdated, why would you say that this approach has been so widely accepted on the retail side?
Because it's simple to understand. Okay, let's just be honest about it. It's about sales.
Yep.
It's about, selling that concept is easy to sell to retail investors. Okay. Don't worry about it. We're going to balance this. So when really bad things happen, it won't go down so bad.
Yeah.
Okay. Well, in reality, it's off. And if you were exposing yourself, and let me say, and we've done a lot of research on this recently, we're in one of the biggest run-ups, probably the biggest run-up in stock market history.
Yeah.
Okay. So common sense will tell you.
Yep.
And we've always known, everybody knows the adage, what goes up must come down.
Of course.
Right? Our belief is that we're going to be seeing the stock market and the bond market go down in tandem together this next time around.
Okay.
When there's a crash, it's going to be a big crash, and most likely both of them are going to be pulled down, and people have no clue that they're in that 60-40 model that was clear back in the 70s and the 80s.
Yep.
They have no clue that they could drag their portfolio down 30, 40, maybe 50%.
Why would you say that the smart money, high net worth investors often consider a broader range of assets?
Well, and they do have a broader range of assets available to them. And the reason is there has to be lots of assets on the safe side. There has to be lots of assets on the riskier side.
Yeah.
And since there are kind of on the smart money or the institutional side, we believe there's more asset classes available, then we can design portfolios like, I'll talk about our Hilton TruWealth portfolio.
Of course.
That, for instance, has different buckets that of risk that you're taking, like a no risk bucket, maybe a bucket that throws off income, a bucket that's managed money, which we're talking about a lot.
Of course.
And again, our retail clients, they've been on the retail side, they come to us, and most of the time they have all their money in that third bucket, that managed money, that quote stocks and bonds bucket. And then, of course, there's the fourth bucket, which is the private equity and alternative side, which, again, the retail side doesn't have available at all. Now, they might make an argument, or a broker would say, hey, we've got REITs, or we got unit investment trust or something, but that's about it.
Yeah.
Oh, we got more oil and gas investments, but they're all designed around retail kind of structures, huge fees taken out of them, all that type of stuff. But the smart money has all of that available in all those different types of investments.
Okay, yeah. So I don't want people watching this to think that we're saying stocks and bonds are bad, but would you say that the goal isn't to avoid the risk, it's to just make sure that each client is allocated properly in those risks?
Yeah, and that's, of course, we're not saying that at all.
Yeah.
And they have a place in every portfolio. Now, in our opinion, in our TruWealth portfolios, that's in that one bucket.
Yes.
Okay?
Yep.
And we work with, of course, we do work with it on the institutional side, which makes that bucket even more powerful and work even better.
So, you just shared a lot about being invested in the market. With that being said, how do you take risk into consideration when designing a portfolio?
So back to those buckets, and we talk about the TruWealth buckets, that there's the no risk bucket, the kind of income bucket that carries little risk to it also, the managed money bucket, and also the private equity and alternative bucket.
Okay.
So we're going to design that, and according to what someone's risk allocation is, and generally we're going to look at their risk level from 1 to 100.
Yep.
And then we're going to say what percentage needs to go in what investment inside what bucket.
Should the level of risk in a portfolio change as the investor's life progresses?
That's a good question. That really is. I'm going to answer this very definitively. Yes and no. I'm like an economist. Harry Truman once said that when he talked to all his economists that would advise him, they'd say on the one hand this, on the other hand this, so it could go either way. And he'd said, I would give my arm and a leg for a one-handed economist. So I would say yes and no, because it depends on it depends on that client's risk profile. Okay, so let's say that we've got a client that's maybe getting into the later years. Well, the traditional retail way to look at it is they need less and less and less in risk. Well, maybe not.
Yeah,
because this is another retail strategy, is that you always want to look at everything in your life expectancy, okay? Or let's say just a 10-year time frame or whatever it is.
Yeah.
So let's say that maybe you've got all the money you need and you're looking at legacy. Well, then why should you limit how you've designed your portfolio to the fact you've only got 15 years left to live or whatever?
Of course.
But people naturally do that. But again, on the retail side, they want you to do that because ultimately that structure, that goes back to the 60-40 structure, kind of generates more fees.
Mark, can you share why the Hilton TruWealth portfolios divides the client's portfolio into these 4 different buckets?
Yeah, and I mentioned them. And again, it goes back to, so here's the funny thing is, the wealthiest of the wealthy, the smart money, doesn't have buckets. Okay, I'm just going to put that out there.
Yep.
It is a little bit more of a retail concept, okay? So it's kind of weird, and stick with me here. Is the reason we do that because it is easier to understand because ultimately the wealthy are using those buckets, but they're doing it in more of a conceptual way. Okay. So we were like, well, how to, like when Brad Hilton and I had this idea to do Hilton Tax and Wealth Advisors, help people that are more average investors do better investing and learn the smart side. We were like, well, how can we do this? Well, everybody kind of understands the bucket concept. It's easy, right?
Yeah.
Okay. So, but the real thing is to break it up to say that the wealthy do have ultimately those 4 areas that they focus on. Now, it just so happens, and if you've watched our podcast before, I've talked about this a lot, the wealthy focus on safety and security first. So those first 2 buckets are massively important because they balance out, they kind of give, if you're looking at like a pyramid, they're the base of the pyramid, okay? And then we go from there in those other 2 buckets that I mentioned, the we're more managed money bucket, we're taking risk, and then we're maybe taking a much higher level of risk, but kind of ironically, since we're so risk averse in general, and because smart money is risk averse, then we're actually in that last bucket, we're usually demanding from our issuers or who we're working with some kind of backstop for our clients. So we can still get really nice returns. But if something goes wrong, we want some assurance, what's actually called surety on the smart money side, that we're not just in it naked and we could just lose all our money if something goes wrong.
Got it. Makes sense. Does every client have the same percentage in each bucket?
No. And it goes back to their risks, their wealth assessment, and I invite everybody to get with us and we'll do that for them automatically and give them an unbiased look and look at it from the smart money side, not the retail side. And it usually is massively different. Our clients know that once they kind of get it, once that light bulb clicks in their head. So that percentage is going to be different for every client.
Understood.
Depending on what their risk level is.
Yeah. Understood. So how do you take taxes into consideration when you are creating a portfolio?
Taxes are huge. So number 1 is safety and security, which is a smart money concept first and foremost. Number 2 is tax strategy. So what did I leave out?
The returns.
Yeah, right. Isn't that weird?
Yes.
Because again, often people will come to us too, which is totally the opposite way we work. Hey, show me what you got, and I want to see your best investments. I want the best return possible.
Yep.
That's a retail mindset. I want to see your best investment. I want your best investment. Okay?
Yeah.
So first and foremost is safety and security. Second is taxes.
Okay.
Why are taxes so important? Because wealthy people understand that the taxes are the biggest expense of your life. If it can reduce your taxes tremendously, number 1 on your income and the money coming in, but number 2 in the tax efficiency of your portfolio, we just basically installed with those 2 things a way to make you the wealthiest that you possibly can be.
So my take there is that, of course, there's risk in being too aggressive, but is there also risk in being too conservative?
Well, okay, there's another concept. Great. So people learn, and we were taught when we were on the retail side, it's automatic that if you take less risk, you're going to make less return. So you don't want you got to take more risk, right? Which again is what retail people are sold a lot. Take more risk and just ride the roller coaster. Don't worry about it, whatever. You got time, right?
Yeah.
So the reality is that taking that less risk, okay, on the smart money side can actually lead to better returns because how it works in the portfolio is when the markets are down and you've designed a portfolio to where you're not taking a giant hit, then guess what? You don't have to sit around for 2 or 3 years waiting for your money to get back to even before you can start making money again.
Of course.
Okay? You can start making money maybe within 6 months or a year because we just used that. So it's a myth On the smart money side,
Yep.
it is a myth that if you take less risk, you're going to make less return.
Right. So what I believe is that a properly structured portfolio isn't simply eliminating risk. It's ensuring that that risk is not controlling the investor's life.
That is true. That is so good. You know, the whole concept of financial peace.
Yeah.
Okay. That's been made so famous. I mean, first of all, by Dave Ramsey, but other people have talked about this even before him.
Yeah.
So the smart money are masters at this. So, and I've done other podcasts on this.
Yeah.
Controlling risk is so massively important because it controls your emotions. Because emotions are the biggest things that get into investing, and that's why retail investors. By the way, most retail investors only make about 2% per year. It's because they're jumping back and forth because of the emotions that have been incurred from when all of a sudden their portfolio is down. And I always talk about this too, Stephanie, and you've heard this ad nauseum, but the downside risks are much more powerfully emotional than the upside is.
Yes.
It's great when everything's going around, everything's wonderful, good, and I just want to see the market. But boy, as soon as you get that statement and all of a sudden you're down 10% or 15%, that's when the emotions really kick in.
Yeah.
And then you make bad decisions. So the Hilton TruWealth portfolios, the smart money, how they invest, they eliminate as much of that emotion as possible. Just put the processes in, put it in place, and let it do its thing.
That makes sense. Mark, if our viewers could remember only one thing from today, what should that be?
Well, going back to, I would say, first and foremost is safety and security. So that's the number one thing that the smart money really controls first. So instead of us starting with, let me see how much return I can make, we do it just the opposite, and the smart money just does the opposite. Let's first figure out how to control my risk, and then we'll go from there. And then we can design a portfolio, because you know what, the returns are going to be there. Warren Buffett has said this so many times. Warren Buffett said that, you know what, there's plenty out there that you can make returns on. Okay, so why not start with figuring out a way to control risk first? And by the way, if you give it enough time, there's many investments that will make money.
Yeah.
Well, by controlling your risk, you're giving yourself time because you're controlling the portfolio, you're controlling your investments. So Stephanie, I would ask you, what is the biggest warning sign you see when clients first come to us when you kind of take a look at their portfolios for the first time?
Yeah, one of the biggest warning signs is going to be that they have multiple investments and they don't really know what the true goal of that investment is trying to accomplish. Investors' portfolio should be designed around the investor and their needs, not the other way around. If you're unsure whether your investments are truly diversified or whether your portfolio reflects your current goals, risks, income needs, and liquidity requirements, we invite you to schedule a Hilton TruWealth strategy session.
We'll evaluate your complete picture and help you truly understand what each part of your portfolio is doing for you.
Visit the link below to get started and subscribe for more conversations about how the smart money approaches investing.
That brings us to the end of today's episode of Hilton TruWealth. If you want to learn more about topics relating to building your wealth, tax planning, cutting-edge tech, and family office services, we're here to help. Be sure to follow us wherever you get your podcasts so you'll never miss an episode, and give us a like or a review. And if you're curious to learn more about your wealth, tune in every Tuesday for new insights and special guests. If you found value in what you heard today, share it with someone who might benefit too. For more insights, resources, and to get a free copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us. Until next time, keep learning, keep growing, and keep building your true wealth.